High yield ETFs are a great investment vehicle for investors who are interested in generating large amounts of dividends pretty much right from the start. You see, with lower yielding investments, even if they have a high dividend growth rate, are going to take some years for the yield on cost to generate any sort of significant income, especially if you don't have all that much principal invested to start out with. But for more dividend income focused investors that are focused on investing into high quality, well diversified ETFs that will not only allow you to sleep well at night, but also pay you a massive cash flow on a consistent basis right from the start. For the investors interested in that, you are going to want to stay tuned to today's video because we're going to go over what I think might be the 3 best high yielding dividend ETFs that check all the boxes when looking for the perfect, or at least as close to perfect as possible, high yielding dividend ETFs. Now we're going to go over all that and more. Right after you please drop a like on this video and subscribe for more future content like this. So the first high yielding dividend income ETF that sort of goes under the radar sometimes that I've been buying like crazy over the past few years is going to be ticker symbol Devo, or the amplified CWP enhanced dividend income ETF. Now heading right over here to the amplified ETF website, it says Devo, the amplified enhanced dividend income ETF. Why invest in Devo? Comprised of high quality dividend oriented stocks along with covered calls on individual stocks, and it has active management, which allows the portfolio manager to identify opportunities and risks and act on those decisions in real time. And also Devo seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So simply put, Devo buys a basket of stocks. As of right now, it's holding around 42 different names and sells covered calls on individual names for this ETF to not only generate more income on a consistent basis, but also to help during downside declines. Now, Devo's holdings breakdowns are financials at 16.9%, healthcare 16%, consumer defensive 14%, consumer cyclical at 12%, industrials at 11%, technology at 11%, energy at 11%, utilities at 3%, communication at 1%, and basic material at 1%. Now, Devo's top 10 holdings are things like short-term government agency, Microsoft, Visa, Procter & Gamble, McDonald's, United Health Group, J&J, Chevron, JP Morgan, and Goldman Sachs. Now looking a little bit deeper into how Devo has performed as far as ETF price historically, the ETF hasn't really done all that bad. Over the past 5 or so years, the ETF has returned around 45% as far as ETF price. Devo is trading at pretty much the high end of the 52-week range, and also Devo does have a 0.55% expense ratio, and because it's an actively managed fund and an ETF that uses covered calls in its strategy, the 0.55% expense ratio is sort of industry standard. Now to get to the good part, Devo is currently offering right now a trailing 12-month starting dividend yield of 4.68%. So not the highest yielding dividend necessarily, but again an ETF that I would consider very consistent, and that also has the potential for some capital appreciation on top of the decent starting dividend yield. Now looking at Devo's historical dividend payments over the past 5 or so years, Devo is a monthly paying ETF which pays around 14 or 15 cents every single month on the month, and I've received hundreds and hundreds of dollars from Devo over the last few years. The next high yielding dividend ETF that I absolutely love and have been buying like crazy as of recently is going to be the JP Morgan Nasdaq Equity Premium Income ETF known as JETQ. Now heading over to the JP Morgan website to learn a little bit more about what JETQ has to offer, it says JETQ generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver monthly income stream from associated option premiums and of course stock dividends. Seeks to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility, and constructs a long equity portfolio through a proprietary data science driven investment approach designed to drive portfolio allocations while maximizing risk-adjusted expected returns. Now, JETQ is a relatively new ETF that was launched just around a year or so ago, and as far as the overall ETF price, it's returned around 1.82% as of now. But again, once you see this dividend, you are not necessarily going to be as concerned or disappointed with the return on share price. Now, one of the reasons, probably the biggest reason on why I hold so much JETQ and why I absolutely love it, is because it's right here. The holding breakdowns is as follow. It is over 50% made up of technology, which again, being more of a dividend income focused investor, my overall portfolios do lack a little bit of technology exposure. So with this ETF being a high income generating ETF, but also being very technology focused, it's definitely a win-win for me. Then JETQ has 16% communication, 15% consumer cyclical, healthcare being 5.82%, consumer defensive being 5%, industrials being 3%, utilities being 1%, financials being under 1%, real estate and energy being a small amount, and then corporate bonds being around 16%. Now, I also like JetQ because of the top 10 holdings. We have Microsoft, Apple, Google, we have Nvidia, Amazon, Meta, Tesla. Now, JetQ has an expense ratio of just 0.35%, and I say just because with the way this fund works, the strategy involved, and the industry standard, it's not all that expensive to hold on to, in my opinion. Now, to get to the massive dividend. JetQ has a trailing 12-month dividend yield of 11.52%, pays a monthly dividend, and although this fund has not been out all that long yet, and the dividends, to be honest, have been a little bit sporadic, with back in October, the dividend being 68 cents per share per month, and then just recently around a 37-cent payout. This fund, of course, is going to pay a different amount ongoingly, and is not going to be as consistent as something like Devo, like we looked at last, but even on the small months, this fund does have an annualized return of a very decent amount, especially with the potential for some capital appreciation on top of that. Just looking as of recently, JetQ was trading at $41 just a few months ago, and now is trading at almost $50. This fund can move in price and it can move fast because, once again, the holding breakdowns are so significantly exposed to technology, which I love. Now, the last high yielding ETF that I think is definitely worth looking into is going to be the SPYI, or the NEOS S&P 500 High Income ETF. Now, heading over to the NEOS website, it says targeted benefits of SPYI strategy. It says, number 1, the fund seeks to distribute high monthly income generated from investing and implementing a data-driven call option strategy. Now, number 2, it says actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities, in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Number 3, the fund utilizes a call option strategy that may include both sold and purchased SPX options, which may provide the opportunity for upside capture in rising equity markets. And the investment objective is that it seeks high monthly income in a tax-efficient manner. And let's be real here, it doesn't really get much better than that. Now, a lot like JETQ, SPYI has not been around all that long, so we don't have all that much data to go off of, which does make it a little bit hard because for investors, we like to look at data, how things have performed historically speaking. But so far, this fund is up in ETF price around 1.09%. But remember, with its strategy of not only selling cover calls, but also buying calls, this fund does have the potential to really rocket up in price if the market does its thing. The 52-week range is 44 and 51, and it's trading at the high end of it, maybe making this ETF a much better buying opportunity a few weeks back. But this ETF does have a 0.68% expense ratio, making it the most expensive fund out of the three. But again, the strategy that this fund uses, it kind of makes sense. Now, the holdings for SPYI are actually pretty decent, with technology being number 1 at around 30%, healthcare 13%, financials 12%, consumer cyclical 10%, communication 8%, industrials 7%, consumer defensive 6%, energy 4%, utilities 2%, real estate 2%, and basic material 2%. Now, SPYI tracks the S&P 500, so the top 10 holdings are pretty much straightforward. But when it comes to SPYI and the monthly payout that it's had so far, we're looking at around a 9 or 10% trailing 12-month dividend yield, with the last 9 or so dividends paid being very consistent on a monthly basis at somewhere around 46 to 50 cents per share per month. So there we have it. Those are 3 different high-yielding ETFs that I think might be worth looking into for the investors out there that are not necessarily willing to wait on their dividend income and want to seek it right away. But I want to hear from you guys down below. When it comes to more higher-yielding ETFs, comment down below your #1 favorite and why. If you guys enjoyed this video, make sure to please drop a like on the video and subscribe for more content like this in the future. Thanks for stopping by, and I'll see you in the next one.